Welcome back to another morning live. I really appreciate you guys being with me today. We're going to get started right away into our house market update. Now, after that, guys, I want to bring us into three different videos. One talking about the UAW strike, another one talking about what opportunities are for consumers right now in the housing market. And then the third video is a video that's going to go into how the market is prematurely pricing in rate cuts. So some pretty crazy things. After that, guys, I'm going to go into a brief article about work from home, and I'm going to tell you what I'm up to this week. And basically, I'm going to give you guys some boots on the ground video this weekend. And then I also have a segment we're going to do after I go into the economic calendar, where Jack is going to come in from NobodySpecialFinance, and he's going to give us a brief report. So I'm going to get started right now, but I just wanted to say, and you guys hate when I do this, and I'm not going to pull everyone's name up, okay? But I just wanted to say good morning to everyone, all right? I just wanted to say that. Please don't hate me, but I'm going to get started right away. I love you guys so much. Oh my gosh, look at all you guys. I mean, I love you. There's Sheldon, there's Scrog. Oh, you guys are amazing. But let me start by showing you where we're at, guys, right now with let's see here. Let me show you guys the economic calendar, because I want you guys to know what's going on this week. And if you guys can help me real quick, let me say this, okay? I'm going to say this before I get started. There's my focus. Help me not say you guys. I know I'm driving people crazy by saying you guys, like the Goonies, like the dude on the Goonies. So help me not say that. It's like a pet peeve of mine. I'm sorry. Count how many times I say you guys on this broadcast. I'm hoping it's less than 5. Anyways, guys, back to the report. So here's where we're at with our economic calendar. This is this week's major U.S. economic reports and Fed speakers. So today we're going to get home building confidence index. Wanted to let you guys know that. I'll be watching that. And really, I'm just highlighting what I think is important. Let me zoom in a little bit so you guys can see that. Now on Tuesday, we're going to get housing starts and we're going to get building permits. What I'm really looking for, guys, is the median sales price and the inventory. So that will probably come out. I think it's the first part of next month in October. Now, Wednesday is going to be a very important day. Not only are we going to get our interest rate decision, which pretty much everyone knows what that's going to be, it's probably going to remain the same. But what I'm really interested is at 2:30, Fed, Jerome Powell is going to be speaking. And based on what he says, the market will react. So I'm really interested to see what he has to say. Now, Thursday of this week, initial job claims. I almost said, you guys, I almost said it, but I didn't say it. Now, Thursday, we're going to have initial jobless claims and existing home sales. Now, let's see what we got going on Friday. Friday, we got a lot of stuff coming out Friday, obviously, guys. But let's see here. Tuesday, we have consumer confidence. Tuesday, we also have the Case-Shiller home price index updating. I'm not that excited to review Case-Shiller because it is very, very lagging. Now, Thursday, we're going to have the GDP revisions. Friday, September 29th is a huge day. We have personal income, personal spending, PCE, core PCE. We have all these types of stuff on Friday. Now, that's not this Friday. That's next Friday. Now, real quick, guys, before I jump into the housing market update, let me just throw up the 10-year real quick. Now, obviously, guys, the 10-year sitting at 4.33. Now, I just wanted to say we hit a record this morning. Okay, so it went up to 4.35. The last high was August 21st at 4.336. So I just wanted to let you guys know that today the 10-year did hit a new record. It didn't end there. You guys can see it went way up here and then it dropped. So I'll go more into that, but let me pull in real quick, guys, a guest that we have. Let's see, Jack. How are you, brother? I cannot hear you because you are muted, sir. I'm unmuting you. I'm unmuting you. I cannot unmute you.
All right. I'm sorry about that. How you doing today, Travis?
Okay. I'm doing good, man. Now that I hear your voice, I feel a lot better.
So are you ready to hear about what happened last night?
I'm about ready to hear. I'm going to get through this market update for everyone real quick. And then I want you to do your report if we can. I'm going to do my first timestamp at the 4:30 mark. And I'm going to take them through real quick. So sit tight with me, my man. So you guys, here we're starting at the 10-year treasury. Everything, a lot of things obviously are based off this 10-year treasury. A lot of pain and even some comfort. The comfort being that I got my money in treasuries right now, obviously. So I'm yielding, pretty decent amount. Now that's putting interest rates at 7.29% on average, that is with the 20% down payment. So that is 7.29% that we went into the weekend with. And honestly, it's probably going to continue to go up, which is really, really astonishing if we think about it. Now, I wanted to show you guys what your mortgage payment would be about, a $400,000 house, which is roughly the average or median house at the average down payment of 18%. So if you buy a house on average right now, it's going to take you roughly $72,000. Whoops. $72,000. And let me put this back here. And your payment, you guys, with your taxes and insurance are sitting at about $2,800 right now. So again, average interest rates putting the average payment at about $2,848. Now I put, again, 18% down payment because that is the average. Now, when we go to the amortization schedule, this is a huge, huge indicator of exactly how expensive it gets to purchase real estate. So right now, again, you guys, average loan amount sitting at about $328,000, average interest rate 7.29%. You guys can see when I calculate the amortization schedule, the total amount of interest that you would be paying is an astonishing $480,000. Puts a little bit of perspective when it comes to renting versus owning. And I also want to continuously remind you guys, this is really cool. The higher the interest rate, the less money it takes to buy down 5 years. Okay, so looking at the amortization schedule, if you guys take, where is it? $18,311. So it's now taking $18,311 to pay off 5 years of your amortization schedule. So again, after you close, if you put another $18,311 down, not only do you save 5 years, you save every tier of interest that I've highlighted right here, making your total savings roughly $116,000 if all you're doing is putting an extra $18,000 down on the amortization schedule. So I want to point out, you guys, again, let me scroll to the bottom. Remember, the last year of payments, look at how much goes towards interest. Only $1,000 on year 30. But on year one, $23,000 goes into interest. And really, you guys, this first 5 years right here accounts for almost 25% of the total interest you would pay over the life of the loan. This is the biggest ripoff, second to credit cards. A 30-year fixed rate mortgage is a huge ripoff, guys. The way to get around that, I almost said you guys, but I didn't. The way to get around that is pay down your principal. And another option is to pay biweekly or make extra payments. Now, if you make $100,000, let's look at affordability now. If you're making $100,000 with the average amount of consumer debt, this includes school loans, auto loans, and credit card loans, okay? And I change, remember, if you're gonna go to the payment calculator or the affordability calculator, which is linked in every single one of my videos, remember to change this to 45%. Okay, so remember to change your debt to income ratio to 45%. If you want the most accurate qualifying, parameters, you got to talk to a loan officer. But this is a good way to do stuff. So you put 45%. I hit calculate, and if I'm making $100,000, okay, on average, I can afford 308. That's it. That's less than the average home. And not only that, you guys, that requires a $55,000 down payment. But again, remember how powerful consumer debt is. When we have consumer debt, it robs us of our purchasing power. So if I remove all the credit card debt, the car loan debt, and things of that nature and recalculate this, it goes from about $300,000 all the way to $491,000. So the more debt you're in, the less your purchasing power is. Now let's take a look at the overnight reverse repo. This is the one-day treasury. This is where the banks are storing their money. And what's really crazy here, guys, is the reverse repo market plunged. I don't know if you saw this, Jack, but the reverse repo market, this is crazy. It plunged, you guys, $156 billion in one day. In one day. So Jack, I think this has to do with the CPI report coming out. It's the market saying, okay, there's probably not going to be higher interest rates for very longer. So they're fleeing the one day. They're probably going into the 2-year or even longer term. But I found that extremely astonishing. Again, you guys, $156 billion left that reverse repo market in just one day. Okay, that is a ton of money. Now, the interesting thing is the market, although the money is leaving, we want to watch the money. The money is leaving the reverse repo market, but look at this, guys. The market is still saying, nah, there's still inflation because look at the 5-year break-even inflation rate is not changing. It's staying the same. This has been the same for what? Since July. You guys, the break-even inflation rate right now is 2.27, okay? The Fed wants this lower than 2. this needs to go lower than 2 for them to start talking about lowering interest rates. So on one hand, when we go over here, the market's like, okay, the rates are about going to stay this high. Let's leave. Let's take our money out, throw it into treasuries. But on the other hand, the other part of the market's saying, you guys are out of your mind. Inflation is still here. And if we think about it, we could probably safely say that the inflation is strongest in the housing market. I would even argue that we had runaway inflation between March and maybe August of this year. So this is staying the same, which again, very, very surprising. Now look at the recession indicators. So our recession indicators, starting with the 10-year and the 2-year being inverted, you guys can see the inversion here. We are now into our 14th month of inversion. The average time when we look at the 2 and the 10 is 15 months. Now, this doesn't necessarily have to reinvert for us to enter recession, but right now the gap is 69 basis points. So it's been about, pretty stagnant. As the rates get higher on the 10-year, this will close that gap of inversion. So here's one more, guys. This is the 10 and the 3 month. I usually don't reference this, but here it is right here. This is actually going back to 1982. This is, instead of measuring the 2-year, we're measuring the shorter yield at the 3 month. And this is, a couple things looking at this chart. First of all, I don't believe this only goes to 1982. We've ever been this inverted. So I don't think we've ever been this inverted. And I also believe we've never been this inverted for that long when looking at that 10-year and that 3 month. This is a huge warning sign right here. This one right here is flashing all kinds of red, way more so when we compare the 10 and the 2. Now, real quick, guys, I just wanted to let you know that, school loans will be starting. Here's a brief breakdown of school loans and how that will work. But more importantly, here's what I want to say. If you're one of the 40 million Americans with school loans, I have a link in my community tab right here, you guys. If you want to go to it, hit this payment calculator and see if you qualify for the SAVE program. And see if you can get your payments down in your school loans. Big shout out to Comic Lover who sent me this link. But on average, if you guys qualify for that, that will actually help you with about $150 to $250 a month on average. So anyways, hope that helps. Now we're going to go into the video of the United Auto Workers strike. But before we do that, let's get back to Jack. And Jack, sir, I heard that you have a report that you want to give us. Is that right?
Something, to shout out to my moderator Mish on my channel who caught this like midnight last night. He's really good. There was what I could only describe as a transient. Something went wrong in the bond market last night, and it was something very big, and it was eerily reminiscent of September of 2019, which became known as repo madness. And it's indicative of a sudden surge in the demand for cash because people were selling, in particular, the 2-year treasury. The 2-year treasury yield spiked last night. Here it is up on screen, almost 50 basis points in a span of about 60 seconds.
Wow.
Right? And we are talking about one of the most liquid financial assets in the world. It's not supposed to do this. Right now, it happened last night. It started right around 8 p.m. Eastern time. And we went from 5.03% yield on the 2-year treasury to 5.49%. So 46 basis point spike in 60 seconds on the 2-year treasury. That does not happen. All right. And it came right up in about a minute. It was slammed back down about halfway. It stayed there for a few hours and then got slammed back down essentially to where it was. Now, it settled a few points higher. Now, nobody knows what happened here. Nobody knows who was suddenly selling, right? When you get a big spike in interest rates, that's a sudden drop in bond prices. So somebody with very deep pockets sold a lot of 2-year treasuries last night. In the middle of the night, there was not enough buyers, and so the price crashed. And that sent the interest rates surging. Now, the number of people in the world who could pull this off is pretty small. China, Japan, a big bank, the Federal Reserve. I'm assuming it wasn't the Federal Reserve. I'm guessing when it came right back down, I think when the smoke clears, we're going to find out that the Federal Reserve stepped in and started buying these things last night to try to correct this. I don't know that for a fact. That's me speculating. But somebody sold a ton of 2-year treasuries last night, and it caused the bond market to spike. Now, yesterday was an interesting time because on Friday was an event known as quadruple witching, which happens in the middle of the month, 4 times a year. That's when you have index futures, index options, stock futures, and stock options all maturing on the same day. Those tend to be days where there's a lot of demand for cash. That was Friday. And then last night, Japan was closed for their Respect for the Aged Day, which is a bank holiday in Japan. So bond markets were particularly vulnerable last night because there was a lot of demand for cash, and one of the biggest economies in the world was closed. So there wasn't a lot of buyers available to step in. And somebody, either accidentally or on purpose, decided to dump a whole bunch of 2-year treasuries, and it caused this big spike in their yields. And it looks like, I don't know for sure, but it looks like the Federal Reserve stepped in to fix it, but it took 4 hours. This was not a glitch. All right. Wow. People are out there on Twitter saying, oh, this was just a glitch. It was a bad print. If this was one guy with fat fingers at a trading desk, it would have gone up and come right back down instantly. It would not have stayed up for several hours. So I don't know exactly what this was, but this is big. You know, you mentioned the reverse repo and that big drop in reverse repo that happened on Friday. Interest rates have been rising. Reverse repo has been falling. Cash is becoming more scarce. All right. So the demand for cash is rising, and we see a sudden spike in interest rates. Interest rates is the price of cash. So this could be foreshadowing some kind of a credit event or liquidity event in the bond market. This may be an early indicator of something about to break. I don't want to sound too alarmist and too fuddy here, but this is not supposed to be happening. We've seen these momentary glitches before, but they didn't stay up for 4 hours when that happened. This was more than just a glitch. And there is nothing in the press about this, Travis. No Wall Street Journal, no CNBC, no Bloomberg. That's worrying me even more.
To recap, Jack, basically what happened is it looks like in the middle of the night, someone sold a lot of those 2 years. And then throughout that period of time, over a 4-hour period, someone repurchased them to get it more in line. And it's possible that the person, the Federal Reserve has purchased them to reset it. And it's also possible like a foreign government or someone ditched that for some reason. I mean, maybe the reason is the rates are going to go up higher, right? And they're ditching that to who knows? Do you have any idea of why that is, Jack?
No, I don't. If you were somebody who was just trying to raise cash, you don't dump it all at once, right? You stagger your sells, you spread it out. You certainly don't do it in the middle of the night Sunday while Americans are sleeping, right after quad witching, when there's a lot of liquidity already. Well, there's already very stressed liquidity in the bond market. And you certainly don't do it while Japan is shut down for a holiday. So whoever did this either screwed up or did it on purpose. If they did it on purpose, they did it beautifully because they hit the bond market when liquidity was at its weakest, with Japan closed and quad witching. So this, and the fact that we still haven't heard from the press, I harped on that on my live stream this morning a lot. The press won't go to print without a quote from the Fed or without a quote from the Treasury or some government official. The press is totally delinquent in their role here as the watcher of truth and, the purveyor of information. They're waiting for the powers that be to give them the official party line before they go on the air with it. So if you go on CNBC, you don't hear anything about what happened in the bond market. Bloomberg, nothing about what happened in the bond market. And that should be the biggest story in the world right now, and there is no trace of it in the financial press. That's scary.
It is, I feel like, Jack, and I don't know this for sure, but I feel like some content is being suppressed, especially when it comes to like warning, trouble ahead. I don't want to put that. Do you have your 10?
I keep this one right here.
Okay. Yeah, maybe you see. I don't have that yet. When I get my tinfoil hat, I'll be a little bit more bold. But I mean, there's so much happening, man. It's just hard to keep your fingers to the pulse of everything, Jack. That's why I really value you, man. So do you have anything you want to add there? You want me to get started on our next segment?
I would just add, Travis, that we saw in the Twitter files that if there is messaging that the government doesn't like, that they will reach out to social media specifically and say, we don't want this message getting out. They'll reach out about certain accounts, right? We know they did it with Twitter. We've seen that they did it with Twitter. I think it would be foolish to think that they don't do it with Google. And I think it would be foolish to think that Google would not comply with that, right? Knowing what we've seen that Twitter did. So the idea that financial content might be throttled or targeted for less exposure based on the requests of they, as I always use, they with a capital T, I think it would be foolish to believe that doesn't happen. It almost requires cognitive dissonance at this point. And that's kind of the story behind the tinfoil hat is like, guys, it's the 2020s and don't call something a conspiracy in the 2020s. That's like saying spoiler alert. So.
But I mean, everything is like, it's not even a conspiracy anymore, Jack. I feel like it's right in front of our face, and all we really need to do is open our eyes and think a little bit about, what's happening. We understand corporate greed. We understand the wealth gap. We understand all of these downward revisions and corrections and the unaffordability. And all we hear in the news is how great we are. The consumer's great. The economy's great. I'm struggling myself, Jack, and I have 3 jobs. I work, 50, 60 hours a week. I mean, I'm struggling out here as well, man. Now, I don't know if you want to keep your tinfoil hat on, brother, but
okay, I'll keep it on.
I'm going to play a video right now that's going to go into the UAW, strikes, and maybe you can share your opinions on that here in a minute. But let's play this right now. It's going to be our first video, Jack, and you can go whenever you want, man. But I'll get your opinions here at the end of this, all right?
On the side,
let me know that the audio is okay, guys.
But how long is that going to last, and what effect is that going to have as the negotiations go on?
Well, I think the communities that are where the striking plants are will be the most affected to begin with. And so they'll work to increase solidarity among those workers. But Shawn Fain has been very good about moving public opinion and emphasizing various aspects of public opinion. The longer the strike goes on, the more effect it will have on workers. But it's the job of the union to really keep the solidarity together of its members and the public at large.
And Peter, I want to ask just a follow-up question. I mean, we just heard Shawn Fain talk about they don't want to be millionaires, they don't want to be billionaires, they just want fairness. Is there, what seems to be the priority for the union, and especially when you think about pay? And there's truth to the divergence in CEO pay between worker pay, right? When we're talking about a variety of industries, there's been a big increase over the years, going back from the 70s to now. What stands out as the priority from the unions?
Well, I think right now pay is a priority, and they have effective arguments there in that there's been a decline in real wages since the mid-2000s in the auto industry. And at the same time, you've seen profits really increase for the auto companies. So this argument, it works for the union, and they're able to show we're suffering at the expense of really increasing not only in CEO pay, but in the profits for the organizations as a whole. Plus, there's public money available for this transition to electric vehicles. So the union's going to emphasize we're not asking for anything that's really dramatic. We're asking, as you heard in that clip, Shawn Fain saying our fair share. And I think that's an argument that will resonate with the public at large as well. Where they deal with things like pensions, bringing back pensions, or cost of living adjustments, or shortening the work week, I think that's a different issue. That adds to sort of these non-wage costs, which can escalate a lot for companies. But I think on the wage issue, there's still going to be some more ground to go there.
I keep coming back to the figure that I saw about how much it costs the big 3 to make cars in terms of the labor cost per car versus a Tesla with an ununionized workforce. For Tesla, $45 to $50 per hour per car. The big 3, it's more in the 60s. So, Kate, do the automakers have a place to say here? It is expensive. This is causing, even though I guess the executives are making the money that they're making, but in terms of the profit margins and the cost per car, that they are getting squeezed to some extent.
We have to remember this is going back to the recession in the 2000s that the workers made concessions. They made concessions on both wages and benefits. They ended up with a 2-tier, which is very destructive for workers because it has workers working alongside each other, making different pay, more temporary workers. Meanwhile, the companies are making profits, not just this year, but in the preceding years, and they've decided to put the profits into, to the CEOs and not the workers. So workers are angry, And yes, the company is, concerned about their future profits, but the workers feel like they sacrificed both in the recession and then during COVID, and they feel like the company was asking them to sacrifice and they're not making the sacrifice.
Unmute. Okay, so
Yep.
we're unmuted. All right, so here, let me just do my first thoughts, Jack, and then I want you, and let's just do about maybe like a minute and a half breakdown. So my thoughts are, as far as the UAW strike is, to me, it's just like, okay, cost of living goes up 40%. Our wages should go up a little bit. But the problem is the Federal Reserve is trying to kill our jobs right now and force us into recession. So to me, the real problem here, guys, is this story doesn't highlight a bunch of people that are like striking to get money. These are people that deserve some of the profit that corporate businesses haven't been giving them. We have a massive wealth gap because of the massive corporate profit. The corporations have been taking the profits, putting it in their pocket, versus in the workers' profit. So to me, this is a sad situation. And honestly, they're doing it in the cups of a recession, which makes it probably pretty scary. What are your thoughts on that, Jack?
If you would have asked me this question in 2009, you would have got a totally different answer out of me. All right. Because I was not on the side of the UAW during the auto bailouts in 2009. All right.
Oh, yeah.
I have done a total 180 on this issue. However, I even got a text message from a buddy of mine saying, "Who are you and what have you done with Jack Gamble?" Because I sided with the UAW in my live stream last week. All right. This is not so much, in my opinion, the UAW versus the CEO pay or the worker versus the C-suite. This is people against the Federal Reserve. And there's a very predictable path that inflation follows. When inflation happens, you get an expansion in the money supply, and then you get asset prices rise. Stocks, bonds, houses, gold, everything, right? Then you get consumer prices rise. Working class people get poorer because their standard of living goes up. The very last step in that equation is wages finally rise. We are now in that last step. We saw it with UPS. We saw it with the airlines, right? Organized labor is leading the charge here, but everybody wants a raise. Even you non-union guys out there, I know you've seen your standard of living drop 20% in the last 2 years. You don't deserve that. That's not fair. The Fed printed a bunch of money and you're just supposed to be poorer? What the hell, man? So I think this is the UAW against the Fed. The UAW is trying to lock in that raise before the Fed kills the economy and puts everybody out of work. And the fact that this happens so predictably, they print money, they cause inflation, the assets go up, the standard of living goes down, and then the Fed causes a recession before the wages can rise. They've done this over and over again since 1971.
Yeah. And honestly, man, and I try to make this point very often because when we had the bank bailout in March of this year, I tell everyone how much that broke my soul, because I remember back in 08, 09, 2010, when they bailed the banks out. When they bailed the banks out, guys, that made them like hyper ultra rich because they didn't bail out the foreclosed houses. So the banks got to keep the collateral. You guys, the banks got to keep the collateral in the last bailout. They turned ultra rich. So it's just so frustrating to me. And that's why it's so important, Jack, that the people that are listening especially understand and are aware what's going on so that we aren't swept away and blown in the wind, and that's really what we're trying to say. Now,
can I give you one more thing real quick, Travis, on this? I know you're trying to save time, but there's some things that were thrown in on that video a lot. CEO pay and fair share. All right. The press is going to use loaded phrases that they have run through focus groups that they know are going to get the conservatives to side one way and the liberals to side another. They're going to try to make this a partisan issue and not a Fed versus everybody else issue. Look out for those traps and those pitfalls. They are manipulating mass psychology when they do that.
I mean, one thing I want to make clear, and Jack, and I tell the viewers this all the time, I almost said you guys, but I didn't say you guys, is at least in our community at Real Estate Mindset, I really hope, and I watch in the comments, I can't respond to everyone, but I hope we're building a community where people are helping people. And that's why I don't want to talk about politics, Jack. I have my opinions, but I don't want to talk about politics. I don't want people to be divided that are in our community. If you guys want to fight and talk smack, just do it in a different place. I want people to grow here and to be aware. And there's There's a lot of hate. Anyways, second video is going to be about missed opportunities and what the current opportunities are in the housing market. It's also going to talk about how much purchasing power has already been lost as a result of the interest rates. And again, guys, remember that we haven't even had school loan starts. So here's our second video. Let me know that the audio is okay. I'm going to mute us, Jack, so that there's no echo, okay?
Yep.
It's not making it easy to buy a new home.
Americans have lost around $71,000 in purchasing power over the last year as mortgage rates have soared. Higher and higher they went.
They're up over 7% this month, making the cost of buying a house hurt your pocketbook that much more.
Joining us now, DeBianchi, real estate president and realtor, former $1 Million Listing Miami star, Sam DeBianchi. About 7.25% based on, Sam, it's good to see you, based on the recent Freddie Mac numbers, the highest since 2001. Eventually, because it's buying a home costs so much more, housing prices are gonna fall.
Yes and no. I mean, we really have no inventory. And all I can say is I don't want to replay any of the segments that I did or any of the other experts did for what was going to be in 2023, because nobody predicted rates where they are right now. A year ago, they were just over 5%, and we have so many people that are still wanting to buy, but it's really costing that much more. But at the same time, of course, I like to provide solutions and opportunities. So where I'm really seeing a lot of opportunities for home buyers are homes that need some work. Buyers in today's market, they want to have it all. They want to have all the bells and whistles, and naturally, because rates are high, so they want to build in everything into that mortgage rate. But if you can say, look, I'm going to have this house for the long run, I'm going to be in it long term, I'm okay with the floors now, I'm okay with maybe renovating the kitchen later on, those are the homes that you can really go in and you can negotiate those prices. You can get those prices down and know that, fine, you have that higher mortgage rate now, but maybe later on you can refi. The second opportunity are home builders. Home builders right now, they want their homes sold. So they're offering rate buy downs. So again, if rates are at 7%, they'll buy it down to maybe 6%. So you should go in there feeling confident, asking for something like that, asking for other incentives like them paying for your closing costs, them cutting down their prices, them giving you options, the option packages as incentives. So a buyer in today's market needs to go in strong and know that they can, in fact, negotiate, because sellers do want to sell.
So, Sam, that's really good advice. And as Dagan pointed out earlier, rates rise, normally prices fall. That's not happening because people don't want to sell their homes. There's a supply problem in the market, so it's keeping prices elevated. So you have high prices and high mortgage rates. Any idea when this is going to break? How does it break? Because this standoff right now is unaffordable for, to your point, so many Americans.
Well, you have to remember too, sellers, it seems like they're having the best day ever, but the reality is sellers are being held hostage in their homes.
Yeah.
Because right now they've locked in 2, 3, 4%, and maybe they want to downsize, maybe they want to retire, but they can't do that because when they sell, if they have to get a mortgage again, a lot of that profit, a chunk of it, is going to now go into the new mortgage rate. So half of my clients who are sellers, they're actually relocating. Some of them just further north into less expensive places, some of them out of state. Obviously, I'm in South Florida. Prices here are still very, very strong, but they're looking at it from a standpoint of, I'm going to sell my house and now I can move to a new area where I can go in and buy that home cash, or I can get a less expensive home and get a loan that's far, far less than what I would have to do financing, let's say 80% of the home. So that's now the seller's mindset. Either a seller can't sell or they have to relocate entirely. So it is a real problem for both the buyer and the seller.
Sam,
but there are solutions and there are opportunities.
And
so I don't want to be Debbie Downer.
You were not Debbie Downer.
All righty. So there's Debbie Downer there, apparently. So sounds like we got two opportunities, Jack. Now, I thought the first thing was interesting, the $71,000 in lost purchasing power. Personally, I thought it was more, and it will be more when payments start. But basically, just to recap what that video said, the two opportunities that we have are trash houses, or number two, brand new trash houses that come with a lower interest rate. So not a lot of existing home sales, not a lot of buyers. I honestly appreciate the first opportunity, which is like that trash house. I honestly think if people are hunting for affordability, and I'm going to go over that at the end here. One of the 4 things that I'm going to talk about affordability is location. So I get the location, but when it comes to primary residences, people don't want to settle for a different location. Like they want to get a specific neighborhood. And when they lock into a specific neighborhood, it could be a little bit harder to find something that's affordable. So Jack, what is your take on that video, brother?
They're first of all, the $71,000 data point makes no sense to me. Are they basing that on the average savings that the average family had before this whole mess? Okay, they've lost $71,000 of the purchasing power that happened. I don't understand that data point at all. That lacks context. It's a garbage data point. It sounds very profound, but I don't think that's applicable for most people. Everybody got poorer, but I think they needed a percentage there, not a dollar figure.
I agree with that.
Yeah. The whole thing about, you can still buy a home here. And, you can still, if you buy garbage or if you buy new home, they're starting this whole context from the perspective of somebody who feels like they'll never own a home. And honestly, all I got from that, I was cringing. The FOMO was so strong there. No FOMO. They are preying on your fear that you'll never be able to own a home, and they're trying to convince you to buy it now at the top with these high interest rates. And I almost jumped out of my chair, Travis, when she said, you can just refi later on. No, you can't. Not if your house is underwater by $200,000, you can't. And oh my God, that's like word for word the Exotic Dancer in The Big Short. Oh, well, Todd says I could just always refinance. No, you can't. If your house is underwater, you can't refi, guys. Oh my God, like the FOMO and the I could just refi, those are the 2 quintessential mistakes that define the global financial crisis and the housing downturn. And they're on TV telling you to go do that again.
Yeah, I like how I like that, because if I'm a consumer, okay, well, I could get this crappy house I don't want, or I can go buy a new house and get some great incentives and I could just refinance later. Who cares about the overpriced house? Who cares about the PE ratios, the payment ratio? Who cares about the job loss and quantity? Who cares about all that? New home builders, if you want to, so it's sneaky, man.
Well, the other thing, the refi, Travis, it has two assumptions, and any one of those doesn't happen, you're screwed. First of all, it assumes rates are going back down. Yeah. I don't think that's a safe assumption. They might not. We could be at the end of a 50-year super cycle here. Rates may never go back down. I mean, it would be catastrophic if that happens, but that's one. And the other assumption is that you still have positive equity in your house and you're able to refinance. So either one of those doesn't fall into place perfectly, you're locked into that trash house that you didn't really want, that you bought at all-time highs at a high interest rate. So I've been there. I did that in 2006 and it sucked. I don't want to do that again.
They leave those very, very important details out. Like you can't just, do things. It's really crazy, man. And not only do you need the equity, you need the credit, you need the income. Like if you lose your job, you're dead in the water. If you have a late payment, you're dead in the water. Like it's just more than just, having equity and a lower rate. There's other qualifying factors that, look at my bright eye. Why is my camera so bright? Anyways, so we're going to go into our last video right now, Jack. Let me throw up that timestamp right now at the 38-minute mark. Now, this video is going to be about basically the market being premature pricing and the rate cuts from the Federal Reserve. And don't forget, guys, at the end of this video, I'm going to go over affordability, but let's mute ourselves, Jack, and let's play this video for them. And thank you for being here, man. I definitely appreciate you here, brother.
My pleasure. Thanks for having me on.
Yields are up today. There's Taiwan semi-news we're going to get to. The dollar index, 9th straight weekly gain. I mean, if you put it all in and you mix it up, what do you take out?
I think we were kind of overdue for this. Listen, in the month of September, we have not yet had a 1% move on any given day. We're sharply unchanged. So today, when you have Treasury yields, which are stubbornly high, near 16-year highs, in fact, when you see the price of oil go to $91.15, when you understand that today is not just a triple witching day, but a quadruple witching day.
The options expiration is going to be interesting at the close.
The statistics behind that, Scott, they're not good. If you go back to 1990, I think Bob gave this statistic, but you go back to 1990, the week following a September triple witching, 79% of the time. The market's down 1% on average is the loss. So bring it all together, stir it up in the pot.
Yeah.
It doesn't make for a good near-term formation for the market.
All that said, Jenny Harrington, the major averages for September, leading into September, we're like, oh man, historically bad month for stocks. S&P's down 1% in September. Dow's flat. S&P's only 3% from its 52-week high. So we talked yesterday about the resiliency of the market. Even Ken Griffin, who was interviewed yesterday, was sort of surprised we've been able to get to where we are, even in the face of all this other stuff. What does it mean? Where do we go from here?
Well, I think with respect to thinking like, oh, September is bad, as we've talked about with the whole, like, is there going to be a recession? The more something's anticipated, the less likely it's going to actually be bad. I am firmly in the camp that I've been in for the last 2 years really now, which is we are range bound. And when I say range bound, I'm thinking of range bound at the S&P level. And that's something that you pushed me on a lot, saying like, okay, but what about beneath the surface? What about the other 493 companies? So I think at the S&P level that we're range bound, but I think if you look beneath the surface, what we've had rolling recessions. And you know what the opposite of rolling recessions is? Rolling recoveries. And so you use the word, Scott, cross currents. There are so many cross currents beneath that surface, and those cross currents create opportunity. So when you say, where do we go from here? I don't think you buy the market, but you can buy interesting things. And so in this tricky market that might be range bound, that might be kind of flat, I think you need to look for companies that have either unique growth characteristics that aren't dependent on the broader economy, that aren't dependent on the industry, but like unique to themselves. So in our portfolio, in our growth portfolio, that would be like Cisco Systems and United Rentals, or things that have unique valuation distortions.
Yeah, but I look at your move. Sorry to interrupt you, but
yeah.
You're doing more trimming than buying, right? You trimmed Uber and XPO.
Right, but we're fully invested.
Yeah, I know, but you're looking for opportunities perhaps to take some off the table of big winners.
Oh, for sure. Okay, fair enough.
Rather than looking to buy the market, even though you say you got to buy this, that, and the other thing. I see somebody who's trimming some winners.
Okay, but so we trimmed 2 winners, right? And we trimmed them simply because they'd grown to like large portfolio sizes and they've had really good returns and the valuations are a smidge stretch, but not enough to make us uncomfortable. And we took some of that cash and we repurposed it and added it to Ventas, which is a company that we added back in June. Ventas is a healthcare REIT. It's really undervalued. That one actually falls into that category of unique growth prospects. So as people have returned to skilled nursing homes, retirement communities, they actually really have a tailwind of rental increases ahead of them. So we've taken money off of stretched valuations, I'd say, and again, not a negative to the company, just portfolio management, and added it to where we know there's unique growth perspective.
So Kevin Simpson, speaking of moves, you're a buyer of some things. You bought more UPS, you bought more Walmart. I saw that sentiment number today, which was a big miss. 67.7 versus 69.2 was the estimate. I'm wondering if we're, in some respects, at an inflection point for the consumer, and if that plays anything into your buying of more Walmart.
I don't know that the inflection point's the reason for it. I think that's the thesis moving forward. If we get some economic slowdown, that the consumer benefits, Walmart benefits from the consumer dropping down. But I still think the bull narrative holds. It might be holding by a string for most of the summer. And as we head into the fall, it's September, it's October, we get a little bit nervous. But the things that have held the market up so far, the assumptions that inflation's coming down, we're experiencing a soft landing, the Fed's done or close to being done, all those themes are still in place, but they become more precarious. And where I think the market might be getting it wrong, Scott, is I think we might be prematurely pricing in the rate cuts. I'm not of the camp that we're going to see them in the beginning of next year. I have a lot of reasons why, but I think we're probably looking a year out before we can really have that conversation.
But I mean, the most interesting thing you just said to me was that the bull narrative holds.
Yeah.
You think the trend is still intact?
Yeah, I do.
Why?
I just think that all of those things are still working, and until one of them isn't, then we're in trouble. So CPI was a little bit hotter, PPI was a little bit hotter, retail sales a little bit stronger, but nothing enough to move the Fed off the narrative next week. Now we'll look at the dot plots. That'll be fun if any of us care what they say. But what's problematic is that November is still going to be on the table, and that presents a problem for the higher for longer scenario to take place.
All righty, Jack. So I'm going to get an article up here, but what do you think about what he's saying as far as, the bull narrative? Are they getting it right? Are they getting it wrong? What are your thoughts there?
I am definitely in the camp of, I think the November rate hike happens. Jerome Powell told us what he wants to see. He wants to see several months of consecutively lower, close to 2% inflation numbers on CPI. We have not even had one yet. We're still over 3 and we're going higher right now. So he's also said he wants to see core non-housing services inflation come down. We have not seen that. Core non-housing services inflation is still going up. So Jerome Powell has told us what the criteria is for an end to rate hikes, and we have not met any of them. So the market's optimism that they're done is really the only way the market is right about that is if something so awful happens that the Fed starts cutting. Well, if that happens, you sure as heck don't want to be owning Walmart stock or UPS stock like they were saying. So I don't agree about the term of the bull narrative. Especially with oil prices heading higher right now, I don't think Powell's going to get what he wants. And real quick, I just want to say Scott Wapner, the host of that show, is one of the few names on CNBC that I can actually stomach. I like Scott Wapner. And what he did there with Jenny Harrington was interesting because Jenny Harrington is there telling people buy stocks. We think there's these pockets of goodness and we think September is going to be a good month and everything. And then Scott Wapner immediately calls her out and says, you're selling. You're telling people to buy what you're selling. And Scott Wapner is one of the few people on CNBC that will do that. So my hats off literally to Scott Wapner for calling out Jenny Harrington for trying to use retail traders as exit liquidity on CNBC.
Honestly, man, I'm so glad you brought that up because the reality is these people that are in charge of reporting the news, more than half of them are trying to sell something. It's all biasness and it's really crazy, Jack, that it's just like the same everywhere. Where do you get clean information? It's really, really hard. So what I want to do real quick, man, is first of all, let me show you guys what just came out right now, which is the Builder Confidence Index just came out, and it did fall, again, obviously because of high interest rates. So the Builder Confidence Index falls to a 5-month low amid high mortgage rates. This just came out right now. But the next segment that I want to do is I want to talk real quick, Jack, about work from home. And also, have the viewers noticed that I've not said you guys? Have I said you guys much on this? I'm trying so hard, Jack, to not say you guys. I just say it. I'm sorry I say it. But anyways, let's go to the work from home. Okay, here's the work from home. Just going to recap a couple things because the work from home is massive. It has changed so many different things and obviously put a tremendous pressure on office buildings, especially buildings that, are from the 1970s and 80s. So I wanted to go over some stats. This was released this morning. So this is from this morning. This is from Market Watch. And again, just highlighting some of the bullet points here. And this is, Jack, think about this. Now, I know me and you fit into the statistic. So I'm like, wait a minute, I am part of the statistic. But this is astonishing, 28% of American workdays, again, 28% of American workdays are now spent working from home. That is quadruple the rate from before the pandemic. I mean, look at the stuff that's normalizing. A startling new report reveals, and that figure rises above 40% in the most crowded areas like parts of New York, probably also like San Diego, Los Angeles, and things like that. Now, this goes on. Just 59% of workers are now going into the office or workplace 5 days a week. Jack, only 59%. So almost half of the people aren't even going into the office. Like that's not how I was raised. It's crazy to me. Anyways, this continues. While most of the rest only go in part-time, the report says, the 3-day week where workers go in. So most people are going in Tuesday to Thursday and they're working from home Mondays and Fridays. That's interesting. This is an emerging new normal, this is saying. Couple last little bullet points right here. There are also good news for companies that want to keep down wages. So you see all this. Let's keep the wages down. Let's make the profit so we can stay in business. They keep taking it out on the worker and the wages that the workers make, because the shift to remote work makes it easier to shift more jobs to lower wage workers in lower cost of living areas. Now, I know there's many reasons for the wage gap, but this doesn't help. Obviously, this is not helping. Now, this goes on. Big city downturns are no longer ghost towns as they were 2 to 3 years ago. Lockdowns, obviously, but many are still struggling in cities with 1.5 million or more workers. Now, With a depleted office class, cities could potentially face the kind of death spiral seen in the 60s and 70s when crime rates spiraled. It took until the 1990s before they started to recover. So we got headwinds, and it's probably going to take a long time for us to get through this commercial meltdown. Many economists also fear a wave of real estate bankruptcies from newly deserted office buildings, a subject only of interest to their owners and creditors unless or until it starts to affect the rest of the economy. So this is basically saying we're not going to talk about it until it hits, mainstream media. But Jack, what are your thoughts on, work from home and whether that's a benefit for workers and how that affects, the employer and then office buildings and things like that?
Well, I can tell you, I have a 50-foot, 20-second commute to work every day. And then, the same thing. Working from home is an extraordinary privilege. It's amazing. And I'm so lucky to be able to do it. And if you are the top talent, all right, the best in the world at what you do, you will demand it. And if you don't get it, you're going to go work somewhere else. So there's all this political pressure, especially from cities, because the cities are desperate to end work from home. They need, their tax base is going away. Their property values are collapsing. Crime is rising. The cities need work from home to go away. Some companies are complying for political reasons, I think, but they're going to lose the top talent. And the companies that offer work from home to the top talent are going to get the top talent, and they're going to get it for cheaper. Because I can do my job from, say, Tulsa, Oklahoma, where the cost of living is 60% what the cost of living in downtown Manhattan is, which means if you pay me the same amount of money, my standard of living is almost double in Tulsa, Oklahoma.
Yeah.
Not picking on Tulsa here, by the way. It's just fact, right? So there's an economic reality there, and it also it extends your range. I don't need to just pull from the available talent pool in Manhattan. I can get it from anywhere in the country. There's more availability. So anybody who doesn't offer work from home is not going to make it in this market. So
it's pretty astonishing. I mean, I like what, I like the advantages as well, being able to work from home. It's a lot less stressful. But I mean, think about it, 4 times higher, Jack, than pre-pandemic. 28% of Americans are working from home. Only 59% are even going to the office 5 days. I mean, that rapid surge of work from home, it didn't allow certain people to adjust to that. And the other problem is some of the employers that are getting crushed by the Federal Reserve are calling workers back home, and from out of state. And so there's, right now that's a level of forced selling. And there's a report that came out, 1 out of 10 sellers right now are selling because they're forced back to work. And some of these people are out of state, so it's crushing them. And then another 20% are selling because they can no longer afford to be homeowners. So we got roughly minimum 30% of the active listings overall, according to the report, 30% are being forced to sell. So what happens when rates go down and people sell, for normal reasons other than being forced, right? Because they want to sell, move, upgrade, things of that nature. But what I want to go, Jack, is I'm going to go in real quick to briefly talk about Subject 2. I did a video yesterday about Subject 2. I just wanted to clean it up a little bit. Basically, what Subject 2 is you have an investor or you have a consumer that buys a house and takes over the mortgage. And what I was trying to highlight is the risk involved in doing that. First of all, when you take over someone's mortgage, you're using the lender's money, and you don't have permission to use the lender's money. And also the seller does not have a legal right to pass that mortgage to you. That's called assumable mortgages. There's a process for that. So I was just highlighting the fact, like, hey, if you guys do Subject 2, there's a whole bunch of risk, and people got all offended. But the reality is you're using someone else's money and you do not have permission to do that. And the lender can call that loan due immediately. Now, I understand it's rare, but I don't care. There's 1,000 videos hyping it up. Let's talk about the risk. I mean, that's what my channel is. So I wanted to read this. This is, from the seller's standpoint. So I wanted you guys to be aware that there's also risk from the seller. So here's a guy that purchased Subto. This is from Bigger Pockets. And I just wanted to read this because this guy made so much money with his Subto, but during the process, the original seller was like needing to buy a house. And like, dude, I need to buy a house, but I can't buy a house because I just gave you my loan. And that's what also I'm trying to say, Jack. Like, if you are a seller and you do a Subto, you're stuck For as long as the buyer keeps that loan, your purchasing power is crushed. Now, this is actually pretty crazy. So this guy bought a house subject to for $186,000. He put a total of $12,000 into the house. Now, he sold the house a couple months later for $250,000 on a wrap with a $40,000 down payment. So basically he did seller's financing basically, and he got $40K. So he, again, without permission, took over someone's loan, and then he sold the house with the mortgage still there. So now there's like another owner that has this encumbrance on their title. Okay, this goes
somebody
on.
else's mortgage. So
That's like two buyers down the line, or it's just crazy. Anyways, so he goes on to say, I liked the large down payment because he got his $40,000 I got up front, but the property never cash flowed. That's the whole point of the subject too. You got a cash flow, right? It never cash flowed, but he got that $40K from that. Anyways, property taxes were too high. Then the property taxes went up. He started losing money every month. Then the guy he bought the house from subject to wanted to buy a new house and needed the loan paid off so he can qualify. You guys understand how this can like fall apart? Like drastically. If you're not a millionaire, Jack, and you're investing in Subto, it's extremely risky and extremely dangerous. Now, if you're a millionaire and you could just pay a loan off if it's called due, maybe you're not going to have as much risk. But I don't think many of these people are millionaires. This goes on. I didn't own the house anymore since I sold it on a wrap. I couldn't refinance. The people I sold to on a wrap weren't able to get financing, and it dragged on for a couple of years until they got their credit straightened out. So again, all I'm saying here, I'm really trying to just emphasize how it is risky to do subject to, and really, we're just paying attention to risk. I mean, I think everyone needs to calm down, but it's kind of, I look at subject to as kind of a get rich quick scheme, Jack. And really, I believe that the better way to find real estate is using MLS and accessing 20,000 active listings, doing a market analysis, see what's selling for the cheapest price per square foot, and do your research there. And if you find a house that's been on the market for a year, reach out to the agent, reach out to the seller, work something out. So, that's the correct way.
You better loop in that bank too. I mean, if you got a bank that could suddenly call that mortgage, that's a huge risk you're taking. Loop them in. If I'm the bank in that environment, right? And say I've got a tenant who's missed payments. If I foreclose on that house, I'm going to seize a house that I'm going to have to sell into 7.5% mortgages. So I'm probably going to take a bath on the foreclosure. It's going to take months to foreclose and evict the guy, then go through the court process and then sell. Who knows what happens to the market in that time? Now, if I'm the bank and I can let a qualified buyer come in who I know can make those payments, come in and assume that mortgage at that favorable rate, now I'm not going to take the big capital hit and the legal expense and take the time to foreclose on the property. I can just basically trade in a better borrower for the old guy. Maybe I'll let that guy assume the mortgage, and I won't call it right away because the alternative is an expensive and arduous foreclosure process. So you may get a bank that wants to do this with you. Don't do this without the bank's knowledge, though. Oh my God, what a huge risk that is.
And dude, they are selling this program like I just took over someone's mortgage and turned it into an Airbnb, and you can get rich overnight. And I'm not just like you guys. Listen, if you want to do it, go ahead and do it. But please, let me just explain a couple of the risks. And the response is like, Travis, you don't know what you're talking about. You could just put it in a trust. And I'm just like, I'm not talking about your loopholes and your gimmicks. Okay. I don't care about that. I'm just talking about the fact you're taking over someone's mortgage. You don't have permission to use the money, and the seller doesn't have a right to transfer it to you. That's what I'm saying, Jack. And it could be called, like, again, if you're a millionaire and you have millions of dollars in liquidity, maybe not a risk to you. But if you're like me, I don't know your financial situation, Jack. I couldn't afford to pay off a mortgage that was accelerated. That's insane. Anything else you want to add there?
No, just if you think you're going to fight a bank and win, good luck to you. Their lawyers are probably better and more expensive than yours. I don't recommend it.
Did I tell you I just got through a letter? I got a letter for a cease and desist letter. Did I tell you this?
No, you didn't.
I got a cease and desist letter, huge #1 litigation law firm from a developer, and I represented myself.
I do remember talking to you about this. Yes.
I represent myself. I've been watching too much of that Netflix series, The Suits. I don't know if you
You're
guys
qualified,
watched The
sure.
Suits. Bro, I was in there. I was talking to these attorneys like, oh, yeah, well, you, blah, blah, blah. Anyways, I watched The Suits. I know how this works, right? But really, man, I was just sweating it the whole time, but I knocked it out. Anyways, so I wanted to let you guys know what I'm doing this week. I may take a break from doing a couple lives because I'm going to go exploring. I'm going to do some boots on the ground videos, and I'm going to show you guys that there's a tremendous amount of shadow inventory or hidden inventory for new home builders. And one of the things I'm going to do, Jack, is I'm going to go out to this area right here and see what's going on. Now, this is basically saying, this is in Texas. Chevron buys dozens of acres for development in booming area near Cypress. So they just purchased 77 acres. All right. This was released 5 days ago. So I'm going to be going out to this community here in Bridgeland, and hopefully I'm going to be reporting back with my boots on the ground to, show the viewers a little bit of the reality that's going on with inventory. Everyone, I know we have low inventory, but we also have a whole bunch of inventory that people aren't counting. So what I want to do real quick, this is the last of it. I'm going to go into some comments that some viewers made, starting with RNT, huge subscriber. Appreciate you, RNT. I appreciate all of the viewers. But UAW 40% raise over 5 years is such a us versus them and divide and conquer non-headline. Just a useless distraction. How do you feel about that comment, Jack?
I do think there's going to be an effort to politicize it along partisan lines, which is one of the ways they keep us fighting each other and not them. There I go. I guess I did an us versus them myself. I'll say us versus they being the ruling class that we don't even know who they are, the puppet masters of both parties.
Yeah.
That 40% raise, it actually ends up being a 46% raise if you spread it out over 5 years. I don't think they're going to get that. They're probably highballing, but understand they need about a 25% raise just to get back to what the real wages were 2 years ago. All right. So,
insane.
And then you're talking about what might inflation do over the next 5 years. My gut tells me it's going to go lower and we could actually see deflation, but I could be wrong and they could turn the printing presses on tomorrow again. And, maybe that 40% nominal wage increase ends up being negative real wages. So guys, in the context of the inflation that we've seen in the last few years, that 40% number is not what it seems like. We have been conditioned to accept lower and lower real wages for our work. And again, 2009, I would have given you a totally different answer than you're getting now. But I don't think they're going to get that full 40. I think they'll get something less. But I don't think it's as unreasonable as it seems like in the headlines.
Yeah, I mean, I want to make more money, Jack. Yep. Unfortunately, companies that I work with, they're struggling. Instead of us getting more money, they're laying people off. I'm in real estate, so it makes sense. All right, next comment here. I am not timing it, but just saying how big the affordability issue is, I have to remember it's not just me, and don't fight the Fed. So what we're seeing here, Jack, is we're seeing consumers, especially the ones on the sideline, whatever their ages are, that are renting predominantly right now. A lot of them are discouraged. A lot of them are losing hope. A lot of people are saying, I missed out on the opportunity of my lifetime. And I'm trying to tell these people, like, I feel you. Like, I'm also renting right now. But the thing is there's so much crosswinds and headwinds that it's probably, and actually, I think with all my heart and soul, that it's best right now to wait a bit. I'm not saying wait forever, but wait things out. Let the dust settle. Let the Fed continue to, stomp demand out. Let's see how much more prices adjust. But in the meantime, get yourself through a recession, right? Credit, income, assets. If we can't take that first blow to the guts, right? Like not going, oh my God, I just lost my job. If we can't get through that, then we can't even become a winner. We can't take advantage of potentially lower prices. So I just want to say to BC and people like BC, you guys are doing the right thing. I showed you guys, if you want to buy now at a 7.25%, look at how much interest you pay. There's nothing wrong with renting when you have a plan in place and when you're growing. That's what I want to say. And it makes me really sad how many people are giving up hope. It makes me super sad. Anything you want to add to that, Jack?
Yeah, the same house right now is a lot cheaper to rent than to own. Right.
Oh,
the same house in the same neighborhood. It's going to cost you several hundred a month more to own it. It's going to cost you several hundred more a month in maintenance costs and everything else. Financially, renting is the better choice right now. And I want to zero in on don't fight the Fed. Amen, BC. Right. What has the Fed told us? That they want to bring supply and demand more in line with each other. That's Fed speak for we want to put people out of work. All right. And if they put people out of work, new home supply is going to hit the market, because when people lose their jobs, a few months later, they lose their house. And right now, this illiquid housing market, if the Fed does what they've told us they're going to do, housing prices will correct lower in a massive way, because they're going to put people out of work, and several months later, home prices will drop when the foreclosures start. Don't fight the Fed. When your opponent can print money out of thin air to do whatever they want, you're not going to win. And they can change the rules whenever they want.
They're changing I feel like they are changing the rules, man. Great answer. Here's our next comment. This is from a man sacred. Remember, everyone can. He's joking, Jack. I'm just throwing it up there just for one more time, you guys. You can't just refinance. You have to have the equity, the credit, and the income. So I just wanted to flag, like, we went into that one already, but here's another one. This is from Don't Move. Really love this guy. Oh my gosh. Yeah. So I pulled this up because, dude, what? So he's a viewer. Email me, man. I would love to, teach you some things. So this, man, I love seeing people in the community grow like this. I'm so proud of these people, Jack. He just got his mortgage loan officer's license. He's moving to Houston in December. Yeah, brother, hit me up. Hit me up for sure. Surprised you didn't get your realtor license. Being a loan officer, in my opinion, it's way harder, but it's also, in my opinion, more important, because it's like how you get money. Money is really important when buying a house, because most people don't have the money. So props to you, man. People thought people that bought a trash house at all-time highs are idiots. So I just wanted to say, real quick, and then he said this is also pretty funny, but, talking about this one, man, I don't necessarily think people are idiots. I have a little bit of empathy for people, Jack, because I understand that the powers that be in the media and the realtors, they're all pushing the same agenda. And especially Zillow and Redfin, all this fear of missing out. So my empathy is in that, like, consumers are leaning on people and trusting people that they shouldn't, and they don't know what they don't know. And to learn the lesson, they have to have bought a house that's overpriced. How is that a fair lesson? Like, here, take this $400,000 house. Hope you make it through, and I hope you learn a lesson, because you're about to. So, I hate. Anyways, man, what is your thought here? I don't think they're idiots.
I can give you my own lesson. I bought a place I wasn't in love with in 2006 because I was afraid I'd never be able to afford a home. All the money I made, I was a commercial fisherman in my 20s. A lot of fun. It was a tough job, but it paid really well. I had a lot of cash. I really wanted to put it to work. I bought my first house. And then the market fell out about a year and a half later. I was stuck with that house I didn't like for years. I didn't sell it until 2017. I was fighting with the association, who was all up in my business about everything I did in my house and the color of my curtains and everything. And they just raised their dues and my property taxes. My God, I hated that place. I hated that place so much. It took me years to get rid of it. I wrote a huge check at closing, and I felt great walking out of there. I was like, I just lost all the money I made in my whole life, and I've never been happier. That's how much I couldn't wait to get rid of that house.
How much were you upside down?
It was a condo. It was a 3-bedroom condo, and I was upside down at it at my worst point by about $80,000, which would have been probably about
that's nothing.
45% of what I paid for it. So, I mean,
okay.
Yeah, I mean, there was no refinancing. Nothing. I can tell you that.
80,000 is no problem. On the condo that I had in SoCal, I was upside down 380,000.
Oh yeah, that's
like, I'm out. Sorry, I failed. See you later. Yep. All right, one more, man. I just want to throw this last comment up here. Now, so I like that also mentioned this, because I did some calculations, and just between last year and the end of this year, there's going to be roughly 10 million new homeowners that are trapped in their house right now. More than likely, on average, obviously, some people get great deals. Some people are buying in decent metro areas that have stability. But I'm just saying, overall, 10 million people are going to be upside down. And if they want to sell their house for divorce, health issues, job relocation, or just anything like that, they're trapped. That's going to create a situation of forced sellings or short sales, or even possibly loan modifications. But right now, again, Jack, people are like, oh, everything's fine, house market's fine. What about the 10 million people that just bought that are stuck? What are your thoughts on that?
I hope they like where they're at, because they're going to be there for a while, or bankruptcy is the only way out of a place like that. And then, you're going to be in a situation where nobody will lend to you for several years because of that. So You know, there's no easy way out of that. And I think we're probably heading back to the days of the zombie homeowners. I don't know if you remember the zombies, the people who bought the house in 2006 and 7 and just decided, I'm not going to pay. And it took the banks a few years to catch up with them, but eventually the banks came in and kicked those people out and seized the property. And then those people had a bankruptcy on their record for 7 years. So, you know, do you want that to be you? I mean, I paid my mortgage through the whole GFC. I guess the joke's on me, but I don't have a bankruptcy on my record. You know, I think we're heading back there. The affordability being what it is, people paying, you know, what was the number you gave me on that appearance you did on my channel? It was something like 40% of your take home pay in just principal and interest.
Yeah, I think it was almost almost 40% of the gross income going to, it was like 38 and change from Black Knight, without insurance and without taxes and HOA and maintenance. I mean, we can just keep going on. I mean, geez Louise.
There's something has to change. Rates have to drop. That's probably not happening. Prices have to drop, or wages have to rise. And the Fed is telling us they're not going to let wages rise. So
I know.
You better believe it ain't going to be rates dropping. It's going to be prices lowering. Don't fight the Fed. Back to BC's comment from before. Don't fight the Fed. You buy a house right now, you're fighting the Fed.
I mean, right. The other option, if prices don't come down, we all make 60% more income. Hey, if we all make, but what's that going to look like? You know, that's only going to last so long. So I want to do this last part, Jack, real quick, because I get a lot of people that are like, Travis, when is the housing market going to be more affordable? And I'm just like, that's a loaded question. Like, what do you mean? So I wanted to talk to you guys about affordability, because really, you know, the way I'm looking at it is there's really 4 things. Let me see here. How do I want to set this up? But there's really 4 things that we need to look at when it comes to affordability. And what I'm going to do, I'm just going to use it like this. All right. So you guys are going to have to look at Jack. But the first thing is that you guys understand, if you want a house that's more affordable, okay, obviously we want to wait for prices to correct. We want to do these things. We want to figure out what's going to happen in the market. We want to be very cautious. But once things become more balanced, remember that, and I'm going to go in level of importance. Okay. So the least important thing first. So if you guys want things to be affordable, number 1 thing you got to understand is location. Okay. That is so important. I'm not telling you guys to settle. But a lot of people that want a primary residence right now will not leave the area that they want to buy in. So if you guys are struggling to find a house in your one neighborhood that you want to buy a house in, remember, if you go about 10 miles away, you might find a house for half the price. Like, for example, in Surprise, Phoenix. Surprise Phoenix is like 10 miles, I think 15 miles from Phoenix. And they have like thousands of houses that are not, that don't have owners that have been built. Now, the second thing is, guys, again, level and importance. Second thing is rates. Okay. Rates have to do with affordability. So what do we need to understand about interest rates? Well, we need to understand what the Federal Reserve has told us and what the market anticipates as far as interest rates. Now, they're anticipating mid 2024 to go down. So if you guys want to see lower mortgage payments from just a rate aspect, it's probably going to start happening mid 2024. But that also depends, and Jack will probably agree, on a black swan. If a black swan pops up and they have to cut rates sooner, so be it. But, you know, pending any black swans, it's probably going to be mid 2024 before rates go down. Now, the third thing, again, this is a level of importance. So the third, you know, this is the second most important thing. Okay. Price. And this is my huge gripe, Jack. It's, you know, I'm not a used car salesman, so I don't want people to look at just the payment. I want people to look at the price. Now, the price and the rate equals your payment. But you guys, obviously, we're heading into some dark months. And I believe so long as next year, so long as we can get through the home buying season with elevated interest rates and quantitative tightening, I think that the prices are going to continue to go down. They're already going down in many metro areas right now, but I think that's going to continue for years if we break through the seasonality in 2024. And I believe it. Now, the fourth thing, and this is the most important thing, if you guys want to find more affordable houses, the most important thing, you guys, is you. Okay. I don't know if you guys can see that. Dang it. There it is. The most important thing for affordability, remember this, is you guys. And what do I mean by that? What do I mean? You're the most important thing. Let me get back to my camera. Sorry about that. So what I mean by you are the most important thing when it comes to affordability, credit, income, assets. The higher your credit, the lower your credit score. The more money and assets you have, the more comfortably you can live. Income is the next thing. The more money you're making, the easier it is to pay your bills. And the biggest thing of all, and I really hope you guys are walking away from my live, especially my lives, Jack. I always emphasize this. I really hope you guys are walking away with awareness and that you are a stronger consumer. So don't ever forget, you guys, most important thing has always been the same. It's you. And that's why we got to be so careful with divide. And that's going to conclude everything I had for you guys. Jack, you want to say any closing words?
I would just add that you is subject to change, right? Don't assume the way you have it now will be the way you have it a year from now. Keep in mind, the most powerful people in the world are trying to put millions of people out of work. So that you may look very different in a few months. You go lock yourself into a big payment right now when all the big guns in the world of finance are trying to put people out of work. That's not just something that happens to other guys. That's something that, you don't think it can happen to you until it does happen to you. My wife and I lost our jobs on the same day when the nuclear plant we used to work at closed. We were very lucky we landed on our feet, and we were able to find new jobs with the same company. But that could have ended very differently. That could have ended in catastrophe for us. It can happen to you. So be aware of that.
Yeah, man. So, all right. Well, let me just part ways here now. I just want to tell you guys, lastly, again, I'm going to get out and go give you guys some boots on the ground. We're going to check to see how much hidden inventory I can show you guys improve by comparing MLS. And then after this video, guys, I'm going to respond to every email. So if you sent me an email, you will get a response today. Please give me a little bit of mercy. I added Julian to my description for correspondence. You guys, it's not about buying real estate. It's correspondence. I have so many people reach out to me. And then today I'm going to give you guys, for this evening's video, the Zillow report. Zillow came out with a report. I'm going to show you guys the declining growth, so it is visible in there. And then, guys, one last thing. Go over to Jack's channel, NobodySpecialFinance. Give him a like, subscribe. Tell him that, whether or not you like his videos. And then do me one last thing, guys. Like this video, comment below, share this video. And other than that, guys, if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.